8.45 trillion yen. That is the staggering estimated size of Japan's massive currency intervention we witnessed this week. Hello everyone, welcome back to AI Market News. Today we are unpacking a historic global market regime shift. We are seeing a remarkable convergence of massive yen buying alongside powerful resilience in US equities, highlighted by a massive 614-point Dow bounce and a semiconductor rebound. Let's explore exactly how these sudden moves are reshaping the financial landscape for all of us. Let's start with what unfolded overnight on Thursday. As you can see in the chart for the USD/JPY pair, the plunge was dramatic. At 8:30 a.m. Eastern Time, solid U.S. second quarter GDP and June PCE core deflator data hit the wire, showing inflation decelerating right in line with expectations. But immediately following this data release, the dollar-yen dropped from the 163 level all the way down to as low as 157.94. According to current market information, Japan's Ministry of Finance and the Bank of Japan conducted a massive yen buying intervention right as the New York Fed reportedly performed rate checks. Now, what is the underlying mechanic behind such a sudden violent drop? Just to quickly break it down, a currency intervention occurs when a government directly buys or sells its own currency in the open market. By the Ministry of Finance and the Bank of Japan selling US dollars to buy Japanese yen, they instantly decrease the supply of yen available in the market. That sudden supply shock immediately drives its price up against the dollar. Meanwhile, the U.S. equities story carried a very different tone. The graph shows the Dow Jones Industrial Average on a one-hour timeframe, and we saw an impressive 614-point rally, closing at 52,213. At the exact same time, the VIX, commonly known as the Market's Fear Index, fell sharply to 16.94. This clearly suggests that the broader equity market has comfortably digested the week's intense geopolitical and economic volatility. So the crucial point is understanding what exactly drove this 614-point bounce. This rally was significantly led by Microsoft's strong earnings and a notable bounce back in semiconductor stocks. The underlying mechanism here is index weighting. Because massive technology companies make up such a large percentage of broader indices, when they report strong earnings and their individual stock prices rise, they mathematically pull the entire index higher, lifting the broader market right along with them. Shifting our focus back to Japan, the Bank of Japan made headlines of its own today. While they opted to keep their policy rate at 1.0%, which was widely expected by the market, the real turning point came during Governor Ueda's unexpectedly hawkish warning. He stated that the BOJ needs to be more vigilant about upside inflation risks and that it is entirely possible to accelerate the pace of rate hikes. He further warned that delaying these policy adjustments could actually lead to economic downside pressure. And this brilliantly illustrates why the currency markets reacted so violently. As you can see in the chart, this daily view for USDJPY highlights historic weekly volatility, featuring a staggering 6 yen swing. Following the governor's comments, the pair briefly dipped below 160 before recovering to around 160.23. The mechanism driving this is interest rate differentials. When a central bank hints at higher domestic interest rates, it attracts foreign capital seeking better yields, which naturally strengthens the domestic currency. Let's move to the Japanese equity markets and see how this builds into the broader picture. The Nikkei surged a massive 2,494 points, or 4.03%, reaching 64,362 today. This sharp rebound perfectly mirrors the resilience we are seeing in U.S. tech indices like the NASDAQ. It was heavily driven by Japanese semiconductor stocks. In fact, Advantest's strong earnings alone contributed roughly 700 points to the Nikkei's incredible rise today. For all of us analyzing these markets, it is absolutely vital to recognize that we are witnessing a profound regime shift. The convergence of a hawkish Bank of Japan, massive government FX intervention, and a hawkish hold by the FOMC represents a structural narrative shift. We are moving away from a story of runaway yen weakness to a new reality that is severely testing the yen carry trade, proving Japan is no longer a passive participant in the global rate cycle. Before we close, let's look at the economic calendar ahead. For the USD/JPY, the key technical levels we all need to monitor based on available data are 158 as support and 162 as resistance. On the macroeconomic front, the August U.S. jobs report is our next major indicator, followed by critical September meetings for both the FOMC and the BOJ. Furthermore, the tech earnings season continues tonight, with heavyweights Apple and Amazon set to report after the closing bell. With Japan no longer sitting on the sidelines of global rate cycles, the question for all of us is, how much further can the yen carry trade unwind before it shakes the very foundation of global tech valuations? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.